Hello guys, and glad to have you on board again today. Wish you all a happy new year. Hope you had some nice holidays with your friends and families. If you had the luxury to have some, of course, because that mostly depends on which country you live in right now. Hell of a 2020 year it has been. And we're not nearly going to talk about that. It has been, for the best and the worst, kind of a painful year. The markets have braced for the best possible option because, once again, that's what markets are meant to be. They're meant to see the positive side of everything. And yeah, 2020 has been definitely an out of the ordinary type of year. And what we're going to be doing as an exercise today is kind of reviewing the key elements of 2020. Of course, in only one way. I'm not just going to talk about what I've done great into 20, what are the good trades, the bad trades. We're going to eventually do it real quick. But the call in here is to take the essence of 2020 and which part of 2020 information can we actually process to forecast probabilities of 2021's direction and kind of set up a major plan. Because this is no more than that. Don't get me wrong. I'm not nearly going to predict the future. Never will be and never has been. So the question out there is really much more about setting a plan ahead of 2021. And let me be real clear with that spoiling the conclusion. It's going to be hell of a painful job to do today, because most importantly, 2020 was out of the ordinary, and generally after an odd year, you're not nearly going to go back to usual, okay? So I suspect 2021 to be kind of a normalization of the shit that happened into 2020. And in that perspective, I suspect 2021 to be kind of a replicate of 2020, but just in a much narrower perspective. Don't nearly expect such big levels of volatility, straight line recoveries, extraordinary money printings, and all of those things that have been the reference point into 2020. Okay, so in a definitely easier way for you to process, I expect 2021 to be kind of similar to 2020 in a perspective that the swing trades are going to be very limited. I expect the market to go really under management, like the plunge protection team more than ever being in control. They've proven into 2020 that they were able to do it one more time. They've been playing this fucking game for 3 years, and they've managed to ripple through the COVID crisis by still using the same old tools, money printing, but far more than we've experienced in the past. It's not just QE anymore. We're sending checks to people. We've experienced global recovery funds in the euro area, something that never ever has been thought in the past. It's something that felt like a dream into euro, somehow according people together to get together some debt. So it's really, at some point, some good stuff happened into 2020, market perspective talking about. So if you think the market has just gone totally irrational, blown off top, it's not nearly the case. There really has been a bright side of 2020. You might not nearly have experienced that in a day-to-day basis because it has been psychologically quite painful for everyone, okay? And being in the confinements at some places on Earth, that definitely wasn't a pleasant time for everyone, okay? So that aside, we're not going to talk about the psychological impact on personal levels of the COVID crisis. We're just going to go on a market perspective today. What can we take out of 2020 ahead of 2021? So the first element we said, probably going to be somehow similar or take out some similarities from 2020 without nearly thinking about replicating. Like the timings are going to switch because nothing ever is a copy-paste scenario into trading. Like I said, some things are gonna rhyme at some point. First of all, very limited numbers of swings. Just like 2020 has basically been 3 swings. The first one, mark top, blow off the top, buying the fucking bottom, and securing the trade. And later on, the market just totally avoided any type of reversal by just buying and printing money to basically fed up the markets so it doesn't think, but just basically goes up. So we've been preventing every type of consolidation because of money printing. But I doubt it's going to work as efficiently into 2021, or it's going to require absolutely staggeringly high levels of money printing, and we're hardly going to manage such a thing. So I suspect, like I said, very limited numbers of swings, probably even 3 swings as well into 2021. The thing is that the 2020 swings have been bringing some staggering levels of gains because of how long these things have gone and how volatile the moves were. Not nearly going to be the case 2021. Like I said, it's going to be similar, but far less amplitude. So limited numbers of trades and very limited numbers of gains. So expect 21 to be kind of 2020 in a much shittier perspective for market perspective. It's just going to be the same old stuff, very boring, lots of impatience to manage to avoid getting into some tracky trades because there's going to be very limited numbers of swings. And secondly, the gains are not nearly going to be comparable to 2020. So you're going to have to readjust. You're going to have to adjust the psychology not to try repeating the processes you've experienced into 2020. Okay? 2020, exceptional gains, not nearly going to be the case 2021. Mostly because most of the gains of 2021, the gains we should have had in a normal market perspectives, have been already booked into 2020. Okay, the market has definitely anticipated the overinflation stuff. It's already in the prices. So the market, at some points, it's kind of beautiful, but the market did a pretty good job. It somehow very well anticipated the fact that we're just going to print our way out of this problem since day one. We've gone into a straight line recovery, and we're going to have a look at the S&P 500 later on. We're also going to have at all of the major asset classes, the FOREX and stuff like that. And like I will tell you later on, not spoiling the conclusion, a lot of asset classes are going to be really tricky into 2021, not to mention that all of you guys who are just getting started with trading or intermediate way of progressing into trading, I better damn hope you're going to listen to me today, because lots of these asset classes are going to be hell of traps for you. Not technical, very, very, very unpredictable, lots of chaos because of multiple reasons. Because from 2020, the only thing we can take out of this geopolitical context stuff in here is, of course, we're getting a new president, but the shit's already there and it's not going to reverse and it's not going to change with Biden as a president. Globalization is over. It's not even a question into market or real market people. I mean, we all talk about it. It's over. It's not going to be ever the same again. The globalization's over, which means a lot of things are going to change. More protective policies, lots of things that weren't there in the past, lots of supply chains are broken and they not nearly are going to recover. Lots of things have changed in the US-China relationship, trying to somehow switch to India right now, and it's going to be hell of a massive change. And big changes means big volatility, lots of uncertainty into market perspectives. Markets like to know what's ahead. So there's going to be some positive side of it, because of course, as we're getting into some more moderate presidency, and that's the least we could talk about, of course, that is something the market likes. The democratic switch is definitely something positive for the market. And therefore, I suspect that this is what's going to help a lot, assessing and reducing the amplitude of volatility. Because, of course, like I said, most of the gains are priced in. The risks are really there. What we've done into 2020, and basically, most importantly, money printing, going to have consequences, like major consequences, but not necessarily 2021. So before moving any further than that, we're going to go assessing the global monetary context, because it has been hell of a major pillar assessing what 2020 has been all about and major impactor into 2021 ahead. So let's switch to some short. It's going to be a long shot today. We're probably on the road for 1.5 hour session today, because so many stuff to talk about, so many asset classes to cover, and I'm not nearly even going to scratch the surface, just setting the motion for the trades I intend to place into 2021, so we can use today's session and today's plan as a reference direction. But of course, like we said, not nearly forecasting the future, so I'm going to have to readjust if I see that for some reasons, the early trading activity just doesn't belong and doesn't fit the plan, okay? So don't take it as a granted futures telling stuff, but more importantly, at the 1st of January, with a shit ton of uncertainty ahead, this is the plan I'm going to follow, but readjusting is definitely going to be all along 2021. Let me be clear with that. Okay, let's switch to some charts. All right, the first one we're going to have a look at in here doesn't necessarily need a technical analysis, and we're actually using a straight line. Okay, M1 money stock. So this one is basically the shortest money stock in here. To make it real simple, if you don't really know what this is, I suggest you actually have a look at this into a deeper detail, but otherwise, let's make it simple. It's basically the circulating money supply, what's circulating into the economy in people's pockets more than the M2 and MZM money stocks, which are basically financial institutions, money multiplier stuff. So of course, much broader money stock in here, including all of the printed money from QEs and stuff like that. So what we can see is that 2020 isn't nearly just about printing money with QE. Like I said, lots of people's checks have been sent out there, and it has staggeringly increased the real economy money stock, call it that way, okay? Let's give it a perspective, okay? 2020 has been increased, this money stock, for 70%, okay? And as you'll see, out of a long-term perspective, you can look way back in history, you're never going to find any such a thing. You can even use a parabolic logarithmic scale. There's not even a precedent into the recent history. As far as modern economics existed, we've never seen such a thing. So it is extraordinary, but the problem is the market take that for granted and thinks and has adjusted to this, which means we now take this as the reference. This momentum, we think it's going to be there for at least a couple years, because of course the market sent a message. If you wind it down, we're going to be unhappy, which means we're going to go real low. And the market participants knows that if we have some financial problem, a financial crisis is going to trigger real quick, because the economical conditions are definitely not at the greatest they've ever been. So adding a financial crisis on top of that is the least we want. So of course, everyone's just trying to avoid a financial crisis, and printing our way out of it is the best, is the best of worst solutions we've found at some point. So it can be criticized on a political level, on an ethical level, of course, but we're not nearly going to go down this territory. I think that anyway, we had to do something, and that's the only solution we found so far. It has worked. Otherwise, we probably would have much lower valuations right now, and probably a financial crisis on top of an economical healthcare problem, okay? But the problem is, as we printed out our way out of this crisis, and let me be real clear before going into talking about the SPX, we're going to talk about the future years ahead, not just 2021. What we've done is going to have consequences. And I'm not talking about tiny consequences. I'm talking about, in history and recent modern history, there's no precedent of printing that much money in such a quick and short notice. The last actual time it already happened in the past is going back to antique years, like thousands years back. And in that perspective, the last time it happened wasn't pretty at all. Anytime a civilization printed that much money so fast, 70% monetary base increase in just a year, every one of those civilizations had several troubles up to 5 years later. So of course, today we have different economics, so things can definitely not be compared one to another. But one thing I think is for sure is, if you think things are going to be fine 5 to 10 years from now, you're probably really dumb, because we're going to have to pay for this, and we're not going to do it at pretty side. There's going to be a massive, unprecedented financial crisis within the 5 to 10 next years. And it's probably going to be even faster than that. That mostly depends on side factors I can't nearly predict. So let me be clear, I'm not one of those perma bears that says that each and every year, like the market is overbought, stuff like that, whatever. No, we clearly have nowadays a ticking time bomb into our hands, and it has a limited lifespan of, like I said, can go down to 2 years up to 6 to 7 years, best of it. We're definitely not nearly going to survive longer than that because of what we've done. We've just set it a ticking time bomb. We're just going to do everything we can to slow down time, but it just can't roll back. It's too late, but like I said, we had no choice. We just did something because we had no other options, but it will have consequences. So if you got me right in here, I'm not just trying to blind you with some fearing perspective and stuff like that. That's not how we healthily trade. So don't panic on these things, okay? Just bear that in mind. It's going to happen in the future, but who gives a fuck? We're trading 2021, and we're not nearly thinking about what's going to happen 5 years from now. We're going to readjust in the process, and we're going to have much more detailed information in the process that can either totally invalidate these probabilities or just foster the countdown. We'll see all about that, and we'll have plenty of time to work it around. The thing is that 2021 has a limited probability of this to show up. We said it's something that we'll bear in mind for the future, but not necessarily for 2021. So 2021 is not going to be a risk-free year. But if you understand the context I'm trying to share with you guys in here, is the fact that in terms of asset pricings, okay, 2021 is locked between a very dangerous scissor conditions, which is basically this. If we go over the weekly charts, okay, 2020, as you can see, has booked lots of gains, where in reality, we had that, a K-shaped recovery. Okay, the real economy is not doing great, definitely not, and all the data we get recently is not pleasant at all. Most importantly, for the lower income persons who are basically surviving check to check and rely on money supply to actually make it. So we do have a lot of problem because this K-shaped recovery happened a lot in the past, in which each and every crisis hits very hard the lowest income portion of the population, and on the opposite hand, makes the wealthy guys wealthier. So of course, that's a campaign promise from the Democratic Party to try narrowing this gap that is just getting wider and wider each and every year. And to prove it, this crisis just made it even worse. The thing is that they're going to try it. I hardly believe they're going to succeed, but we're going to see what the politics side of it is going to be. I don't and I won't go down the political side of it. But I suspect that anyway, we can take something for granted. Trump is going to go out of the office. And that's, I'm sorry to say it if you're a Trump supporter, but hell of a good news for me. I don't like the guy. I've always been clear with that. It doesn't nearly fit for a presidential job. But anyway, if you like it, I can understand. We're not going to go down the political stuff today. It's just like anyway, market prospectively talking about, it's going to be a good news for the market. The market didn't really like Donald Trump. It did everything to make it believe like it was, but it definitely hasn't been. The markets like visibility. They definitely don't like tariffs, Twitter-like presidents, and all of those things. So the market likes Biden because it has a lot of visibility. We know what it's going to do. We also know that some of the things it will do is not necessarily what we like, financially talking about, but it's not necessarily that bad. I think things somehow balance each other. So we'll adjust if necessary, but right now I think the market sees the positive side of it, visibility. Okay? Taxes are going to be among the process, and it's not going to be the good side of it, but we're probably going to process this anyway. So political side, I think, is just giving us one information, a side of potential volatility. And let me be clear, this is Trump's era, breaking resistances, breaking support. Can you even think about the dumbest possible outcome for markets? It's definitely the Trump era to me. The stupidest possible economic situation, overheating an economy, dealing with the shit, and finally the blow-off situation, printing historical amounts of money out of an historical crisis. Exactly what I forecast the Trump presidency to be, and it actually turned out to be messy, violent, divisive, and finally printing a shit ton of money, because that's what Trump does. When the shit hits the fan, it just takes someone else's money to pay for the shit and takes credit for it. Of course, that's exactly the final stage in which he took credit for the nice V-shaped recovery that the Fed created for him. Okay, so that's about it. What we're going to go with Biden is just not going to be the case. I think Biden has one thing for sure versus Trump, and I'm not nearly saying it's going to be a better president and stuff like that. I just think it's going to be market talking about. Just going to be a cooler president. Last but not least, lower volatility. So I suspect 2021 to be, like we said, the replicate of 2020, probably 2 swings and a final third swing to the upside. But just the thing is that the timings are probably not going to be as violent as that. I suspect kind of a drop, kind of a recall of the COVID crisis, and the same type of recovery ahead of 2021, and probably another jitter. But I suspect the market, unless we do have some external factors signaling a huge change into this perspective, I suspect 2021 to be a replicate. Just don't think about these timings to be the actual good ones, but I think we're going to have just a replicate, a short-term, really dangerous sentiment type of movement, recovery later on, probably printing our way out of this one as well, and probably going to terminate the year closer to the high points. But I think 2021, definitely not going to be no more, I think, than probably a doji candle. Pretty much closing, I think, slightly higher than the current prices, not nearly staggeringly high like some people are targeting some stupid stuff. We're going to talk about possible alternative in which possibly we could get an absolutely staggeringly speculative bubble, which I think is not nearly going to be the case. Biden is not going to let that happen. So I think Trump could have created another bubble, a really dangerous one. I think Biden's just not going to do it. It's just going to reduce the volatility and cool down the market that has been actively overstated, overtraded, over volatile for 4 years. And finally, we're going to get over this. As a trader perspective, wow, Joe Biden is definitely a much better president for markets than it has been for Trump. Okay, so that aside, let's go into some more technical stuff out of politics. Otherwise, I understand some people might disagree with my vision, and I'm not trying to say you're wrong and I'm right. You're free to think about whatever the fuck you like. And like I said, I don't like Trump as a person. I'm not nearly going to go any way further than that. If you like him, I can understand that. Okay, so 2021, few swings, low volatile movements, and a much shrinker wave amplitude to be expected. To me, 3,200 is going to be a hell of a support for this year. And if not, I'm going to assess for the first quarter to at least try playing and gambling for these levels. So that depends on how fast we get the first drop. And let me be clear, as we terminated the year at the high, there are several probabilities in which the first quarter just somehow keeps pushing with limited short-term volatility. And I doubt we can pile up some nice gains. We're just probably going to go 45-degree angle, slow, flat positions. I suspect at least Q2 is going to get a rebound to the downside. The target for me is to reach out to at least 50% context. That's the bare minimum for it. The second course for me is to use this trend channel as a reference. So as you can see, it's hard to predict, but this is pretty much what it looks like. So I have a cluster timing for this area, 3,200, approximately May, for a possible sell may go away, but hardly can predict any timing this year. We're going to have to play as time passes, okay? More importantly, this trade and this swing, just like this one, is going to be only for experienced trader. It's probably going to be painful, very low volatile market conditions, so very dangerous for reversal traders. I definitely only want the most experienced ones of us trading this. Others simply will have to wait for the buying opportunity. Okay? So the bare minimum to buy is this level. You just don't buy any fucking thing unless we get there. The minimum is 3,200 to buy some stocks this year. And don't even think about doing it any faster than that. Okay? I think that's the swing people are looking for. The buy call into some volatility expectations that brings price to some more acceptable level. If you think about what we said previously, why do I say that? Simply because there are still risks. We've seen and we've said that 2021 still bears a little bit of risks for financial crisis conditions to trigger. Still fairly limited because I suspect these things to come over in the following years, not next year. So limited conditions for really risk-averse market conditions, but still existing risks and already piled in gains, which means at the list of a trigger stuff, anything that goes not according to the plan will probably trigger some risk-off move in which the smart money is gonna ask for lower prices to manage the underlying risk structure. They're not gonna ask for a 30% pullback. We're not nearly going into this territory. But I would say something like -15 to -20, 25% at best is what we might expect into 2021. And that's probably the best things you can get. Like we said, don't think it's going to be hell of a volatile year. It's probably going to be the opposite way of it. Okay, so don't overestimate the target. Just have a plan. I'm not buying anything unless we get below 50% context, and this context is going to move over as time passes, and it mostly also depends on how high we go through the first quarter, because going higher is going to bring the resisting context higher, which is going to rise the 50% context higher as well. So I am really dependent into the trading information I will get in the process to actually define my tradable areas. At the current given time and for the first quarter, 3,200 is the area I care about, not nearly trading anything higher than that, okay? And it's going to be higher and higher as quarters passes, okay? Now, next thing we're going to talk about, and that's an absolutely essential, crucial one for me to navigate 2021. I think that what we're dealing with is a very complex sentiment, and I will give you two scenarios, and I just don't even know which one is going to be chosen by the market for the first quarter. First option is I think what we've experienced recently is this, breaking resistances and breaking support on the sentiment. I think sooner or later we'll get for the lowest boundary. And that's where we're probably going to get the appropriate timing to get to buy. The necessary fearing sentiment to push prices down to supportive areas in which I think the smart money is very likely going to support prices. But I'm looking for an extreme fear type of market that goes irrational fearing conditions in which we're going to find some interesting opportunities eventually. There's going to be price dependent. Of course, I'm not going to buy without signals, but I am going to require more than signal this year to buy. I'm going to require an extreme fear sentiment. Okay? I suspect that at the point when we get this extreme fear and prices at least below 50% context will give us favorable conditions to look for buying entries on shorter time frames. Okay? That aside, like I said, that doesn't mean we're going to go there immediately. We can take at least 1 quarter to get there, like kind of a very low volatile first quarter, getting into the presidency. Like I said, cool down after the Trump's era. Things will just look so cool compared to the shittiest brainstorm we've experienced with the Twitter president. And in that perspective, I suspect we can get the smart money sentiment right back up to 80, creating some kind of a divergence. Because after expanding, I suspect 2021 sentiment to shrink. Like I said, I think we're going to go into some extreme fear territory just one time. And afterwards, basically concentrating the sentiment, narrowing the market's volatility. And that's what I think 2021 is going to look like. So ahead of the fact that it's going to be a hell of an unpredictable year in terms of timings and amplitudes, but the fact that I suspect amplitude is going to be much shrinker than people expect it to be into 2021, I also think sentiment is going to shrink as well. But I'm looking for the lost extremes at the early stages of that year and later on building some ranges, and possibly at the end, probably Q3, late Q3 or Q4, I suspect a bullish breakout could show up only if real economical condition starts to improve. If they keep deteriorating to a dangerous level, we could take our time-ticking bomb and shrink the countdown. But very limited probabilities for this thing to blow up on our face into 2021. Okay? So that's much about it. The second thing to assess is that it's not nearly just going to be about the smart money sentiment. The smart money sentiment is going to be necessary tool for me to figure out where to buy. Where to sell, just like we said, is going to be hell of a painful stuff to figure out for the first selling signal, okay? And this is where I think the dumb money is going to make the difference. As you can see, we've been concentrating recently, like the retail traders still are net shorting a market that goes up. They always do the opposite of it. The other day, first trading session of the year, we've gone down. People were just basically buying, just doing the opposite of what the market does, pure and simply. Now that the market is rising back up, they're selling. So I'm trying to tell you just one simple thing. I'm going to do the opposite of what these guys do, but I know that this is going to be absolutely unpredictable. Trading or assessing what the dumb money is going to do is like trying to read a poker player that doesn't know how to play poker. You're just basically reading someone that doesn't know shit about tails, whatever the thing that is. So they're basically unreadable because they don't even aware of what they do. And in that perspective, they're randomly doing things, which means they're totally unpredictable. They're just going to randomly go against the market moves. But most importantly, I think the market is just going to do everything it can to wrong foot the retail traders. So, as I can't predict what the retail traders are going to be doing next week, but I can somehow feel what they're going to be doing next day, this is what I'm going to be doing. Short-term trading all across Q1 and just doing the opposite of these guys. If they buy, I'm selling. If they sell, I'm buying. Pure and simply. Just taking the trade in, getting the fuck out a couple hours later, no more than that. They're buying, I'm selling and taking profit on the next support. They're selling, I'm buying the support and selling on the next resistance. Short-term gains, short-term sites, short-term trades. I'm not nearly doing anything different for the stock market, at least until we get the reverse I'm talking about. When we get the drop, when we see the sentiment pulling down below the 50 level and heading toward 20 and below 20, I'm going to start looking for the midterm supports, at least below 50% context, to start looking at potential first trades to the upside on the investment portfolio. Okay? So that being said, switching back to trades, I'm not nearly going to buy the S&P 500. Too boring to me. What I'm going to be doing instead is looking at buying individual stocks, stocks that can provide some momentum, stocks that have definitely interesting structures. Not going to buy the whole shit, because like I said, this is going to be boring. We're going to hit low volatility because we're going to have such great assets that they're going to have some huge momentum, and we're going to have some shitty assets overloaded with debt into a debt crisis coming along the way. So investors are not going to buy them. It's going to be hell of a pain. Some assets are going to go down, some are going to go up. This is why we're going to get a messy range and unpredictable in this perspective into 2021. The only stuff we can do, and that I will do with the experienced traders, is to arbitrage the indices one versus another. Like when the market is preferably going for this sector rather than this one, I'm going to buy this sector and eventually short sell a more defensive sector that goes down. I'm just going to arbitrage indices versus another index. Basically, buying one, selling one to get a less riskier trade. But that will mostly require knowledge that you don't yet have and trading lessons I haven't yet recorded. Reason why I'm going really, really cautious on this. Okay? So as you can see today, retail traders are getting against the market. The market's going up, so buy the motherfucking supports, target at resistances. Don't be greedy, don't be dumb, don't look for massive gains. Don't try to think that you can let go with half the position for forthcoming trends. They're not going to happen. We're just going to do one day up, one day down, one day down, one day up. Totally random stuff. This is why it's really requiring a lot of experience. So if you're not experienced enough, I suggest you get the fuck out of trading indices otherwise than using your well-known strategies and third range boundaries on shorter time frames. Okay, that aside, letting it go with it, okay? It's going to be dangerous, but if you know how to master ranges and you very well handle your psychology, you can definitely do it, but don't be greedy, okay? Take all the gains. Don't try to take it off to the highest possible price and down to the lowest. It's really more about taking short-term, low-risk amplitudes in the process. Just not trying to sell at the high, buy at the lows. Larger stop losses, tinier position sizing, and consistent day-to-day work until we get the first swing of the year. Probably, like I said, hell of a volatile thing because we're going to look for irrational bear sentiment. Okay, so it's probably going to go fast, straight line, very painful for those who try to buy the dip too quick and stuff like that. Okay, out of this, other areas of interest. The 10-year yields, you're not going to trade that motherfucker because that's hell of a bubble we have into the bond sector. But most importantly, that's hell of a very bad signal that has just been sent. Just the first trading sessions of the year, okay? We're crossing 1% for 10-year yields. Let me be real clear. When this thing happens, after a yield curve reversion, shit is down the corner within the next 2 to 3 years. So once again, just confirming what I just said previously. Shit is down the corner, and I'm not lying. I truly think it. And I'm going to need hell of a clear and clean signal to change my mind on this, because otherwise, I'm damn sure we're going to have hell of a pain trade to come. And I'm not talking about collapsology or stuff like that. I'm just talking about the fact that we're going to get a deflationary crisis within the next 2 to 5 years, to 6 years, okay? Because, of course, first of all, we're going to try fighting against it. We're going to try printing our money. We're going to try printing our way out of this. But the problem is just it's not going to work. At some point, it's going to fail. And when it fails, we're going to get hell of a crisis. And it's going to be long to get out of this, probably a couple years of deflationary processes before getting back to healthy markets. Okay, but that's a topic for a later day once again. Just bear that in mind. Limited risks about that for 2021. So you don't go down this road because this is where the smart money is going to manage the risks of maintaining higher asset prices. But we have a bubble with credits and we have a shitload of money into this. The Fed is for now supplying, which is for now buying, which is creating demand for a market that no one wants to be in. But they're just getting in and offering because they know the Fed is there. So as long as the Fed is there, there's some unsustainable but acceptable level of confidence, but the problem is we're in a bubble system, and the bubble is starting to reverse something that has gone on for 40 fucking years. So don't get me wrong, it's gonna take years to reverse, but it's already in motion, okay? So don't go down this road, really professional stuff, and I'm only going to trade this with really the top 10 guys of the experienced traders I've getting to trade with into the Discord. That's pretty much all about it. So don't go down this sector. Finally, the junk bonds. Don't trade these as well, but I'm going to use these as a reference point. So either first trading sessions of the year, prices reverse, go down, retail traders are getting to buy it, we rapidly get the pullback, and we're going to fail below these resistances and basically fail out there, okay? Second option, okay, as we're starting to have rising moving averages, we do kind of a stupid trap. We're going to get for the higher time frames context. I doubt we can go right up to the trend channel in here. That's really way too high, but I think we can at least try to get there, okay? Try to make a fake breakout. Breaking this trend line, trying to break above this level, we're probably not going to last very long, and then I suspect we're going to get the troubles. Okay, so that's an additional cluster for reversal traders, though only the experienced one. We're going to look for a junk bond fake breakout. Okay, so we're going to look for cycle breakouts on the shorter time frame, very likely daily to 4 hour. And when we'll get reversal context on the junk bonds, we'll know that we get an appropriate timing to start selling stock markets. Until then, as you can see, I have red flags in here. That means I'm selling these sheets. I'm not nearly going net bearish right now. I'm just covering my trades. I'm just out of the market. I have some buying trades into individual stocks, and I'm just selling the same amount on broad market indices, pure and simply. I'm looking at bear trades on the NASDAQ right now, but on a really short-term perspective, and if they don't work out, I'm just going to get the fuck out of here. It's just that I'm trying to use the better momentum of these because it's going to be a more volatile asset. So as I expect volatility to be low on the S&P 500, I use this one as a cover trade, and I use this one as a better trade for tiny short-term bearish exposition, trying to figure out if the market is going to reverse earlier this year or going to wait for a later perspective type of trades. Okay? Like I said, what orientates one scenario rather than the other is mostly what the retail traders are going to be doing, which means I'm going to navigating on sight. I'm not having any plans. I just know the reverse trade is either going to be within the next week or it's not going to be until at least mid-February or something like that. And I'm going to readjust as time passes because I'm going to need the junk bonds to break their resistance first. I'm going to need to see like I said, the retail trade is going to some very dangerous exposition in which at some point the market will blow them into the opposite direction violently. Okay? So VIX and junk bonds are going to be my referring asset to trigger the reversal trade timing. Okay? The second thing is, like I said, for the buying trade on the S&P 500, I'm going to look at both the sentiment, but the smart money sentiment this time, okay, smart money sentiment into oversold territory or extreme fear territory, and at least 50% context, possibly the support trend channel if we can go down this road, but probably no lower than that, okay? That's it for stocks, that's it for derivatives and bond markets. We're going to talk about crypto and save them for later, of course, because, oh, that has been hell of the rocket ship of 2020. Down this road, USD WTI, let me be real clear, is going to be my asset of the year. This is the asset I think is going to be the easiest one to trade. It's going to be a complex year, but I think USD WTI is going to be the easiest one to navigate. The only one in which I can give you prices I will trade upon. So here we go. Okay, we're going to go out of logarithmic scales. We don't nearly need these. Okay, I've got a first resistance area in here. So far, absolutely no signals in the short term. I'm just looking at how prices are dealt with in there. But, oh, damn it, we might see some early reversals, actually. Just need to see the signals. Okay, nothing yet. Okay, so waiting for it, okay? If it's not now, it's going to be next week, pulling higher and higher into the speculative area. Of course, as time passes, the speculative area is going to go high and high, okay? We readjust. As the signals I have in here, I know it's going to be sooner rather than later, but I still have no signals to properly go against that. That's a reversal trade again, so this one is not for the beginners and intermediate traders, only for experienced reversal traders. What I can tell you to do for everyone is to look for the pullback that will show up. $40 down to the 50% context. So it's going to be this, okay? Trend channel bare minimum. down to at least 50%, it's going to give me the first speculative area to the year. If we get out there, no matter how it goes, I think it's going to be correlated to the stock market. But the thing is that I can hardly figure out the area where to buy into the stock market. I can definitely tell you that $40 down to 35 is going to be bought into the WTI. So look for prices pulling back on all of those supports, wait for signals, but this is where I think we're going to get the trade of the year, the only trade in which I will use leverage personally on this portfolio this year. Other trades, like I said, I'm going to go on site with limited position sizing because I know 2021 is going to be a chaotic year and I just don't want to expose normal capital into a year that is going to be trickier. Okay, once again, a trader is not there to predict the market, it's just there to limit chaos. To its bare minimum, so we can get some risk limitations. And like I said, there's going to be a ground high level of chaos from 2021 because of what happened into 2020. It's not because of Biden and stuff like that. Biden is probably going to try shrinking this chaos level, but just can hardly do a perfect job. There's still going to be a lot of rippling effects of 2020. Both from monetary perspectives, political perspectives, and stuff like that. Trump's just not going to shut his mouth. It's just going to be there 2021 still. Okay, second asset, much more complicated to trade. USD WTI, and there's going to be a nice, absolutely nice selling trades if we ever get 60 to 65. Okay, 60 to 65, just to zoom it out so you get a perspective, is definitely a big level to me. Okay, this level in here, possibly, okay, I would sell it, where's my, okay, I'm going to go our horizontal level. I think it's, yeah, it's this. Okay, so this level for me is going to be the level to sell. Absolutely huge support out there, quite of a resistance. If we get in here this year, which means same thing as stocks, if we just keep pushing up, okay, like no reversal signals through my first speculative area. The next one is anyway in here, I'm short selling, no questions asked, because we'll get the reverse, the resistant context to get in true. And I'm personally going to sell blindly. Okay, so $60, I'm selling just blindly, of course, with a stop loss and stuff like that. But if we get there, I'm selling. I'm definitely buying, like we said, 35, 30, 40 at least, 35 possibly is the interesting price to get to. That mostly depends on the signals I get into this area to readjust. But these are the capping levels for me into USD WTI this year, in which we can both play supportive and resistance trades, in which I think leverage is going to be possible in between. XAUUSD. Oh man, this one's going to be hard to trade. I think it's going to be an interesting asset, but it requires to give me an answer first. An answer I still don't have, and I think the market is going to give me pretty sooner rather than later. I think the timing is appropriately linked to the indecision I have for the first quarter. Are we going to go for a low volatile first quarter, keep inching higher and higher in each and every day, or afterwards going to get huge unpredictable momentum to the downside with retail traders fueling more downside by buying the market stupidly? Too quick. So in that perspective, two options for gold. And like I said, this one is going to be navigated on site. If we go for a low volatile, going up slowly but steadily throughout weeks and stuff like that, we're going to get a surge in gold, I guess, because this one's going to have to follow the correlated risk. Like I said, risks are really there. They are not at zero. We have risk and we just not price them in, which means we're going to have to price them in somewhere. We start pricing them into higher yields, but it's definitely not liquid enough because of the Fed totally blowing this market. The only market in which they can't do anything is this one. It's already out of control. They lost control a couple years ago, and this one can totally go into blow-off territories. That's a necessary condition. So I think if we go for a boring first quarter on the stock market, we're going to get a staggering gold to trade. But like I do not know right now, and I have mixed feelings with these two, they sending contradictory signals within the next few days we've had of early 2021, so I can hardly give you a preferable scenario for now. I'm navigating on site. But if stocks go for bullish trades, like I said, I'm not going to sell. I'm not going to fight against. I'm not going to do like the retail traders will do, trying to sell each and every day and stuff like that. I'm just going to go quickly buying support, selling below resistance, end of story. But I'm going to try trend trading the gold. I don't think this one is going to go real fancy, but the first limitation is going to be reaching out for this perspective, which leads me to the same timing as, like I said, So I think if we go for a first boring quarter, I do have a hell of a cluster in here surrounding March or something like that, in which the trend channel is going to go in here. We're going to be on top of the resistance context, and there is where I think gold can go. And that is an area in which I will like to make gains, because there will be far more gains to make in here and far safer gains to make rather than buying the stock market on a swing trade. Because like I said, it's going to go up one day, down the day right after, then up, down, up, breaking support, fade breaking, up, down, stupidly, boringly chaotic. So this is going to be boring. This instead is probably going to be trending because we already have a preceding trend. Okay? So that's all about it. Next. I don't care about these ones. I could talk about them, but we have a long perspective. Okay, Forex. Oh, fuck, we have a lot to talk about. Okay, so I'm going to make it plain and simple. Euro dollar, USD/JPY, GBP/USD. Don't fucking trade them in 2021. Please don't. For a simple reason, and I'm going to go straight to the conclusion in here, not long arguments. We are in economic war. And you can be damn pleased that we are not yet into military wars, and goddamn hope we'll never go down this road. That's the major reason why I'm so happy to see goddamn Trump out of office, because he's a dangerous psychopath. But just anyway, we're safer than this way with him out of the office. That is shrinking the probability of military conflict, or at least possibly is shrinking, and we'll see all about that. Right now, what's for sure is that the economic crisis that is already in the game for a few years is just getting absolutely outrageous, and it's just going to go worse and worse. So unless some H1 trades, some things that will last for a couple days, or intraday trade of the day into those assets, despite that, don't swing trade these. They're going to be just so chaotic because they're just going to be manipulated, and I'm really wisely using that word, okay? Though that means all of the major currency crosses like EURJPY, EURCHF, no, it's not a major, but still. USD CAD could be interesting, but most of the gains have already been made, so we'll eventually talk about this one later on. AUDUSD, I think, is going to be an interesting trade to make, but most importantly, what I think is the most gorgeous asset for me heading into 2021, if it actually turns out to validate what I think about, is going to be AUDNZD. Because AUDNZD might be on the verge to finally give us an appropriate timing. I just want it not to get back into the loading area. Just saying, because I think this was an excess low point due to COVID, basically. And I think that we've gone excessive and we're never going to get there again. So if that's the case, I don't want the market to loading on the bulls in here again, just retracing back to resistances. If we do that, we're probably going to get a breakout. I can hardly explain that because that's patterns I haven't taught you yet. But in here, we're going to get a breakout because we're definitely, I think we can range in here for a bit, okay? It's more about finding the appropriate timing in which this market go look for that resistance, because if it does, I'm going to leverage trade this motherfucker. You know I'm looking for this one for years if you're following me for a long time. So you know I've been really shitty timed out of this market because I thought this was my asset of the year in 2018. I tried again 2019, been fucked again in 2020. Eventually 2021 is going to be the right year, okay? It's just, I've never seen such a mature range. So like I said, markets are unpredictable. And statistically speaking, the probabilities for this to last such a long fucking period of time is just out of ordinary. But, I mean, if things were predictable, I would be a billionaire. So, eventually 2021, but like I said, I'm looking for finally a market that managed its way into breaking this fucking resistance. If it does, trend trades are going to trigger and it's going to be hell of a trend. For a simple reason, because of course, if you have a look at the way we've traded in here, very low volatile all the way through. So it has been a straight line from this area to this one. If we pull back to this area, I expect the market to do the same straight line to the opposite direction, reaching out for this resistant context. And I think this can be done within a year. It can take, of course, much longer. I can't predict timing. But I think this can be an asset ready to produce staggeringly low volatile gains, which means use of leverage will be possible eventually. All of those things will have to be confirmed throughout 2021, but that's something to bear in mind. My assets of the year, this one and this one, Okay, this one is for sure. This one is to be confirmed. Okay, and like I said, this one eventually, of course, but just for the first quarter. So no Forex this year, unless short-term trades, but don't swing trade these guys. H1 time frame can be traded. Anything higher than that is going to be hell of a complicated mess because of an economic raging war in the background. If you go for major asset crosses, it's going to be hell of a pain in the ass probably in here as well. USD CAD, like I said, could be used, but very complex in here as well. All right, that being said, that's it for Forex. We're going to have to talk about stocks real quick. We still have the same problem. Bubbles, Apples, Amazon, all of these guys have very dangerous short-term context in which if Amazon just breaks its support, this is a diamond reversal, expanded momentum, and then contraction coming from a low volatile input price means if we output of there, we're going to go straight line back to the previous area, just like we gone up. So it's a straight line going down. It's basically the same pattern as Boeing did with the COVID. Okay, so if you do BA, okay, just look at that, same pattern, okay? Oh shit, sorry, expanded moment, come on. Expanded volatility and then contraction when we break, straight line to the downside after going straight line to the upside. This one is a necessary condition, okay? If you go in there with swings, that simply doesn't work out. So you have to go in there with low volatility, means when we go out with low volatility and we just go back to the previous support, generally just like Boeing has done, breaking slightly the previous low points and then ranging for a freaking long period of time. Now Boeing is not nearly going to recover, it's just going to blindly, boringly trade into this area, or even go worse if the structure keeps deteriorating. Okay, so that's what I suspect for Apple. In a different for Amazon, I think Amazon is fairly overpriced today. It's not nearly the type of asset that's going to die. I think it's just going to go there, trade there for a couple of years, and eventually later on reactivate for a staggeringly bullish perspective. But that's the topic for another day, definitely not for 2021. So that's an asset I'm willing to buy, but I'm first of all looking at this perspective and this potential opportunity of an diamond reversal to show up, heavily pulling back and harshly pulling back to those areas. Like I said, we're very likely going to break this support for the short term, no more than that. So I'm looking for this cluster in which, of course, selling out there will be blindly stupid, okay? But looking at buying can be interesting for someone who's ready to hold for a few years, of course. Apple, I'm going to be real straightforward. This is an asset I'm going to sell for 10 years. Probably even more than that. I'm going to do this in multiple steps. The first one is the one absolutely forbidden for everyone but me, is to try shorting the speculative crash that might come. It's generally a 40 to 50% price drop, very dangerous, very violent, lots of people getting totally wrecked because of irrational use of leverage, but this is something fairly complicated to do, and I still have absolutely no clues of validation, but anytime I get these, oh man, I'm gonna go in. So don't try to look for this, okay? It's not really the trade that worth it, but if it triggers, and if the market drops violently, you must be aware of something. Try to catch the dead cat bounce. Looking at Apple, I think it's hardly going to retrace right up to $100 per share. And if it does, sell the fucking crap out of it for 10 years. Okay? That's something to bear in mind as well, because of course it requires validations first. So don't try to look at Apple on a day-to-day basis. Just wait for it to trigger. I'll let you know when to get into selling this crap. Okay? So the only thing you must be aware of is if you are holding Apple with prices above $90 and if you have used margin trading to get your shares, fuck me, get to profit take rapidly. Because if this thing triggers, you're going to be among the losers who are going to be blindly fucked because of margin use in their trading. Microsoft, I don't give a shit. Google, I'm probably mostly interested into buying it, but in a couple years from now. Facebook, I don't know where this thing goes. It's not nearly irrational, but I think it's made hell of a course. But most importantly, I think political problems might be down the road for this asset. So eventually it goes higher after blowing. I'm not buying anything more than a 20, 25, at least a 30% pullback for this asset. And I don't even know if I want to buy it. Tesla, I'm out of the road. I profit took a few days ago. It keeps on rising, but actually I don't nearly give a shit. I don't know where this thing is wanting to ride to. All I care about is I'm going to buy at least 50% retracement of the 8-time high that will be made. I'm just not nearly looking at buying this thing anymore. I'm just going to buy on pullback. And this is not something that will trend later on. This is something that will just do a point A to point B straight line asset and just going to blindly oscillate in there for probably 5 years, probably even more. So it's going to be a boring trade, volatile, absolutely stupid asset. So only for those who like roller coasters and know how to manage leverage, because of course we're going to get shitload of momentum, shitload of better trading in here. So we're going to require really tiny position sizing, and I'm going to both buy and sell the crap out of it. But I'm just not trying to short sell this, because this is of course an asset that has huge growth potential. It's just like right now we don't even know what it's worth. People are just trying to see how high the dumbest thing is going to be buying. So it's really all about that. It's a robot stuff, putting things higher because there are too much short sellers. So we're trying to go higher to wreck them. And when we'll find not enough buyers, this thing will collapse in just a few days. So I'm not nearly looking at buying it, at selling it for the crash down. I'm just going to wait patiently for appropriately lower prices to try looking at buying. When we'll retrace, I'm selling and buying and selling and buying and selling, and probably replicating this thing for multiple years later on, exactly the way I navigated it into this period of time. All right, Virgin Galactic. This is something, I don't know where this thing's going. All I know is that this is one of the asset potential I'm looking for throughout the next few years. I think we're going to have a short growth period. Like I said, I think 5 years, 6 years at best is what we can expect before blowing the entire financial sector because of too much leverage and too much debt. But until then, we're probably going to have some trending assets. Some assets are just going to dry out of liquidity and die. Some others are going to go parabolic. Trends and whatever, because of over liquid markets, means that the trends will likely be parabolic. But I'm looking at specific sectors when it comes to stocks. I'm going to look for AI specifically. I look for Google or some specific shorter assets. But this one is probably much more going to be more about trying to buy Google for this sector. So I don't think this is where I'm going to go into deep level of details. Automotive is basically Tesla has already been there, but I already made my gains, so I don't suspect there are any more gains to make, but just to buy the low area of a possible forthcoming range. So most of the gains have already been booked in. I'm going to play the aftermath, probably trying to get together the crumbles on the aftermath of these upside trends. I'm hardly going to buy, eventually I'm going to buy a competitor, but I still haven't figured out a reasonable candidate at the moment. I'm going to buy a video game tech derivative like Logitech. I'm looking for this guy. Lots of people are buying into this, which means I don't expect huge pullbacks out there. But I hope I'll get enough volatility when the extreme fear moments will show up, so I'll be able to buy that at cheaper prices. But I'm probably not expecting huge pullbacks. I'm probably going to get back into electronic arts and reinforcing positions on electronic arts, possibly getting into CD Projekt Red, but I need these guys to really lower the prices to get there. So this is the second perspective of sector I'm going to look for on individual stocks, but the one I'm going to take a lot of work to persist, and we're going to make a specific video all about these, is the biotech sector. I think this is going to be the growth sector of the following years, not nearly 2021, but we're going to prepare for a forthcoming parabolic shape trading activity on biotechs. So this is still something speculative, but I'm probably going to buy some speculative biotechs. Not the shittiest small caps, of course, but some things, okay? Some very speculative asset, probably 10% of my investment portfolio on 10 stocks with 1% capital on each and every one of these. I expect that I'm probably going to lose money on 8 out of the 10s, but I hope eventually I'll get to gather some 2 of these that will make a 20, 30, 40, 50 times, 50-fold on the returns if I manage to catch one that will be heavily demanded by the traders. Of course, I'll ride my way in and increase the position sizing if the bubble actually triggers. But biotech is going to be one of the sectors I'm looking for on the eventual pullback, and the only buying timing we've seen and I've told about earlier today, earlier in the perspective. So biotechs, AI, robotics is another sector I'm looking at getting myself into. I still haven't figured out a reasonable candidate for robotics for robotics right now, but I'm going to work on this and we'll make specific podcasts of this. Okay, so individual stocks, the only one I care about is short selling the goddamn Apple, but don't look at the reverse. Wait for the dead cat bounce, and I'll let you know when each thing shows up if it triggers. You can trade the breakdown on Amazon, but wait for the breakdown. Like, okay, it's not if we go to the support, you sell. It's when we break the support, you get in and you look for this area in which you buy yourself out. End of the story. You just go on a straight line momentum, easy trade. Take Boeing as a reference if you want to figure out how these things works. That's pretty much all I know about stocks. Otherwise, there are individual stories on stocks. But like I said, I'm mostly looking at buying these rather than selling. I'm buying individual stocks rather the couple ones I'm selling, and otherwise I'm short selling indices. And I'm also, like I said, going to try arbitraging these sector versus sectorial, okay? When there is a leading sector, I'm going to mostly try buying these. When it's all about selling because the retail traders are buying, I'm going to look for the most bearish sectors, pure and simply. Okay, that's all about it. Finally, we're going into crypto. I guess some of you guys just wanted to get out there first, but I wanted to save the most interesting things for the end. And let me go straight to the point. Okay, so Bitcoin. What do I forecast for 2021? Are we going to go for $200,000? No, I don't think so. I think that what we might expect for the year is, first of all, assessing one thing, one timing in particular, is the fact that we've already talked about that, but heading into October 2021, we're going to get the good old ratio in which the halving, okay, that happened in there, is the replicate of the time that it took from the halving point down to the lowest points preceding. Okay, it was 88 bars. So take 88 bars in the future. That gives us, oh fuck, what the hell's wrong? No, halving is there. Sorry, I think it's there. Jesus, I don't remember the date. Fuck me. Oh, I'm fearing to say some bullshit. Okay, anyway, I think I've done this thing, and if my memory's right, it was leading to early October 21. So I'll take that as a reference, but something to be verified, okay? So 4th of October, I think it was 11th. Okay, so we get out there. That's the time in which, looking at what we've had in the past, we're going to get a dangerous timing. So this is just a timing I'll bear in mind. I think this is something to look for when we'll get to October. So early Q4 is something we're going to have to look for, okay? Then, until then, I think that we're probably going to have a pretty boring Q1 because we've already booked so much gain in just a few days. If you have a look at the year candle, we've already made this in just a few days. So let me be real clear. I think this year is going to be boring on the first stages. Let me be giving you another tip. I think that's something to, of course, verify. Like I said, I'm hardly going to make a definite plans on the 1st of January for 2021. I think this is an area we're going to oscillate across throughout the year. So I can hardly say how we'll go. 40K eventually 42. I don't really give a shit. The higher we go, the lower we'll get later on. Because I think the center of the maze for 2021 early stages, probably Q1, Q2, is going to be oscillating across 32K. I could take a long time to explain why. Just trust me on this one. I think it's going to be the level of equilibrium for the early stages of that year, oscillating in there, probably building a range, boring range, till probably Q1, Q2, okay? Basically slowing down the momentum so we get a nice 45-degree angle on the average, okay? So like going something like that, okay? And we rapidly shrink volatility, and we will probably get in here, for those who are longer-term investors, the second buy and hold opportunity, which will act as a confirmation that the market just wants to shrink volatility, and when the momentum will reactivate, like I said, the linear regression of the trend has to be less steeper than that. We're going too fast, we're going too stupid, and if we want these things to last, as I think they can, and if we want to go to higher levels and valuation, which I think can be reached out to in approximately October, I think we needed to do into two waves. The one we've started since September can't perform longer than that. Of course, can go 42, 44, 45. I don't give a shit about the number. All I say is that we're going to get back to 42 to 32. At least that's what I think about. And the higher we go, probably the lower we'll get, because that's something I like in market. It's hardly going to be explained, but the market likes symmetries. So I think the higher we get, the lower we'll go. So at the current given time, if we were going to fail at 38K, I think the expectable bullish levels would be 26K. If we go 40, expect 24. I doubt we can go down to 20. That's the reason why I suspect the market top to be happening between 38 and 42. That's something, once again, I'm not looking at selling the goddamn coins. Not ever. I'm only profit taking when necessary, and let me be real clear, I'm not profit taking anything for Bitcoins right now. I've made my long-term profit taking for validations on my buy and holds on all of those assets, just not this motherfucker Ripple, who just got real close to my profit taking before crashing the damn thing. But anyway, that's the missing thing of 2020 for me. That's the only thing I'm so pissed off about, because it's just got so close, and I've made hell of a good job on this one. Just man, all the gains just blew off. Anyway, no problem. Things happen. Yeah, there's always one trade like that every year. So that's the area in which I think you should really think about cooling down. So if you want to take a good advice for trading crypto 2021, 32K. If you want to buy, don't buy any fucking thing until we at least get below this level, okay? If you want to sell or profit take your profits above 32, okay? Because this is going to be the 50% very likely level for a forthcoming range. And this, like I think, is going to be a very boring range, like two swings. The first one, you shouldn't even look at this one. It's a very dangerous reversal. In trying to reverse a market that goes this way, good luck. Secondly, okay, think about this symmetry to figure out about the likeliest probability of the most interesting prices to buy. Expect an area between 28 to 24K to be the very probable ones to be bought, okay? I doubt we can eventually go, I think we can hardly go below 24K. Think about the fact that this trade, pretty much way too risky to get in there. You can eventually trend trade in between, but when we get out there, just absolutely forbidden to sell below 32. Only look at buying, and of course the lower the better, okay? Just assess the fact that there's going to be one very interesting trade to make for everyone in 2021 into cryptocurrencies, is to trade the goddamn following third range boundary. Just, if you buy, profit take the shit out of it, sell it with your gains, and make a single trade trying to go to this area and then end off the story. I think then later on, volatility will probably very rapidly shrink, and that will be a freakingly healthy signs of trend. People will be like, oh man, Bitcoin is boring, there is no momentum anymore, 32, okay, so eventually 40K is the highest we could go with Bitcoins. Okay, eventually, of course, because we don't know the future. If we get out of this range to the downside, then we're probably going to retrace back to the previous historical highs. But if we reactivate to the upside, this is where I will personally reinforce my exposition to cryptocurrencies with the cash I took off the table from my profit takings. But I'm going to wait for this. I'm going to make a couple trades, probably buying this one, selling this one, and then let the dumb traders deal with the lowest volatility until it's so low that when we reactivate, I'm going to jump on board. Okay, that's for cryptos. Now, alt season. Are we going to get one into 2021? I haven't changed my mind for this one. I can hardly predict the momentum, but I think we can have the glimpse of an early 2021 alt season. But I think this alt season will be led by Bitcoin going out of its range. I think that what we can get is, whilst Bitcoin is going for this, okay, let me be back to this, when Bitcoin will eventually do this, and like I said, I'm not forecasting the future, I just think this is the likeliest outcome. I think Bitcoin will take way longer to actually process this volatility after reactivating. I think actually AltCoins will give the early signs of Bitcoin reactivation. I think AltCoins will start leading the way, and then Bitcoin will follow. I think this is the appropriate order to do things, and that's something that will normally push the BTC dominance heavily to the downside. I suspect that as we go for the next few weeks and eventually month, I suspect this thing to be boring for a simple reason. Market likes not to give the answer to the question. We try to build a double top market, and it's going to be pending validation until we break a support. And the first available support is the previous high point. okay? So I think the market is going to be locked into this area for a long time until we actually validate. And only when we do it is where we're going to get probably all-time highs on Ethereums and stuff like that. Because when we get that, this is where possibly the alt season will start triggering. And if you got me right, there's not going to be an alt season until we break 58 on dominance for Bitcoin. So we can have staggeringly bullish altcoins, but it's going to require the Bitcoin to slow down, and it's going to require these guys to start trending before Bitcoin. Okay? That's the only possible way. All right? So this is something to bear in mind later this year. I can hardly predict the future because ranges are very complex structure. And I don't know how long it lasts, but as long as we do not break 73, and as long as we do not install value below this level, it's going to be painfully unpredictable out there. So I think right now is not an appropriate time to go for arbitrages. All of the arbitrages I've been talking about in the last weeks have all reached out their targets. So it's not about time to go arbitraging anymore. I think it's about time to let go with the cryptocurrencies and just wait for the forthcoming third range boundary on possible range trades that might emerge. Despite that, just do nothing. Okay? Be patient with cryptos. I know it has been the leader asset of 2020. I know that you probably very likely want more, but be rational. It's probably not going to be 2021's assets. Or eventually on the second part of 2021, after a pretty boring range in which lots of retail traders will look for momentum that will simply not show up. All right? So we'll readjust that on course. Of course, lots of the plans I've shared into this perspective in here are absolutely foggy and stuff like that. I wish I could do better, but that would just be stupidly lying to you, because I think right now every rational professional trader knows that 2021 is not going to be an easy task to navigate. It's going to be a wait and see. It's going to be a readjust and stuff like that. I have just a few plans I have a shitty high level of confidence on. USD XAUUSD as a reference measure of risk on the early weeks of 2021. That's it. AUDNZD only if it validates. All of the other trades are going to be trickier and they're going to require more short-term approach. Okay? And then, of course, individual stocks that will provide some nice trend-following opportunities or overlapping supports, all of those things. And we're going to make a specific podcast out of these because, of course, I'll do my best to try sharing the assets I'm going to look for. Okay, that being said, that has been hell of a long ride. Sorry, I'm a talky kind of guy, you know that. So let's get straight to conclusion right now, if I manage to do it. Okay, oh shit, that's really dark. Yeah, I mean, this is... Okay, give me a couple seconds. I'm going to try managing something. Okay, that should be better now. I'm sorry about that. I mean, this is external lighting stuff. And yeah, I mean, I'm not editing those videos. So yeah, this is real quick live updating on there. Anyway, so as a conclusion, I'm just going to try summing up all of the core information. I spent quite a lot of time into details and stuff like that, but I think it's necessary because once again, what matters in here is not the conclusion that I get to. I think if you just blindly follow me, that makes absolutely no point, and that certainly isn't what I'm trying to achieve out there. What I'm trying to do out there is to show you the process of getting into conclusions so you can either pick the ones you actually feel like you like as well, but rather like thinking about the process, because that's what I like to share with you guys, so you can make and draw your own conclusion later on, just showing you how a professional draw its direction and its line. And like I said, 2021 is going to be more about readjusting constantly rather than putting a straight line and following it. I'm just going to need to do it because anyway, I need a direction, even if it has to be readjusted later on. Every professional will have a straight line. So I know it's going to be complicated. I know lots of assets will be putting some very noisy, chaotic ranges. I know a lot of 2021 is going to be about sentiment. So using the sentiment indicators is going to be absolutely key element for you into 2021, aside from the technical elements, okay? It's not like you forget about all the strategy stuff and you just get to replace that with sentiment. Okay, sentiment is just going to be an additional level of triggering trade to trigger trades into 2021, specifically into stocks. But lots of derivative trades are going to come out of what happens into the stock market. So really, really important stuff to use sentiment throughout 21 to efficiently trade. We're going to have to use correlations a lot because, like I tried to let you think about it, there's going to be a lot of trickier underlying correlation and stuff, which is normally some lessons I do for the most experienced traders on the community. But I'll try teaching you the basics earlier into 2021 so you'll get at least the bare minimum to efficiently use viable positive correlation systems, rather than just saying, okay, this thing looks like it's correlated to the other without knowing shit about how correlations truly works. So I'll try giving you the core elements of it throughout the trading lessons. Then the derivative contracts, VIX, VVIX, junk bonds, 10-year yields and stuff like that are going to be used as we speak as derivative measurements, correlations to define more appropriate timing, okay? So if you sum up the informations, we're going to need derivative information contracts coming from bond markets and derivative volatility measurements, coupled by level of sentiment, key levels of sentiment. We're going to wait for panic to buy, okay? And we're just going to do the opposite of what retail traders are doing in the meantime, okay? As this thing goes on, we're going to need an additional stuff, which is using another derivative as a potential trigger, which is the one we've talked about, the gold. I think gold can be used as a trigger for the only, I think, tradable swing into the S&P 500 for reverse trader, okay? So for reverse trader, we're going to use gold as a trigger and junk bonds. For the buying the low point, we're going to look for VIX as a resistance level. We're going to look for extreme fear, and we're going to look for bullish signals, pure and simply. That's all about it, okay, for stock market. For the Forex market, just trade fucking short term. H1 time frame is going to be okay when you see a context you're familiar with. Only trade the things you really know. Just don't try to go into uncharted territory on 2021. Or if you do it, really the tiniest possible leverage on your position sizings. The only, I think, Forex asset that can be interesting, it's probably not going to be the only one, but that's one I think is really evident in here is the AUDNZD. For a simple reason, this one doesn't nearly give a shit about the commercial war and the economic war we've had, simply because these two countries are so depending one to another that I think something can come out of this. Of course, it's going to be a unilateral because we do have a big country facing a tiny country. So they're going to be friends, but like cheating friends, okay? So that's the reason why I think trends could emerge, but safe trends, or at least the safest trends we could get from Forex. I could go down explaining why into much more detail, so just trust me on this one. But I need a validation. I'm not just going to trade what I think, okay? So if I see validation on AUDNZD, it's something I'm going to trade, and I'm definitely going to use leverage on this one. Second asset I'm definitely sure I'm going to use leverage on too is the USD WTI on the levels I've told you about. The around 60 area is going to be a tough resistance, and I'm definitely going to sell if I have signals. And until and when it validates, if the reversal validates, I'm going to go leveraged rapidly on these trades. Same thing goes on the opposite direction, which I favor the most. Aside from buying and selling, I'm mostly looking at buying the WTI. I'm going to sell it as well, of course. But if you compare one-to-one, I'm probably going to use leverage in both directions. But I'm probably going to use more leverage to the upside rather than the opposite one. Okay. The gold, like I said, tricky thing to trade only if we have a boring first quarter in the stock markets. I'm going to ride a possible trend on gold, but only looking at first resistances, not going too fancy, unless we go total bubble, but that's a fairly limited probability for me. And if we have to go down this road, I'll just make another year update to tell you about the markets just going absolutely below off top bubble, which I doubt because it simply doesn't fit the Biden context. If we go for a massive speculative bubble like the everything bubble, everything's just bought. If we go for this, I'll just simply record another video just basically telling you, okay, flush it all out, forget about what we said, we can just change it all, we go for bubble mode, we buy everything, and then we make sure we're going to be safe when the shit hits the fan, and in that perspective, it's just going to be out of 2022. If we go for a bubble, it's probably not even going to last 2021, okay? That's the reason why I doubt it's ever going to happen. Though Forex, we've talked about that, individual stocks have a goddamn plan, okay? Think about some stocks you want to buy before the shit happens, before the momentum drops, before the sentiment falls off the cliff, because you must have a list, a narrow list of 20 assets you want to buy, because when the shit happens, it's probably not going to last very long. Let me be clear, I think it's going to happen in less than an hour, meaning that the interesting tradable prices for you to get in those trades, 1 hour. So be ready. Because when the thing starts to lock in and prices starts to fall, we're going to have to put conditional orders into the order books to make sure we execute it. And we're going to have to follow all these trades rapidly, because managing 20 trades, getting in, seeing how they react or not, is going to be messy if you're not well prepared. So you have to do it right now. So the only thing we can do is, right now is a boring market condition. Nothing is really moving as we want. Take this time to prepare. Make a short list. Like I said, 20 assets, no more than that, but do it. Of course, if you have an investment portfolio. If you do not have that, if you're just a speculative trader without enough money to go for an investment portfolio, well, like I said, short-term trading on stocks is the only fucking thing you're going to be able to do right now. Or short-term Forex on a day trade scenario, whatever. But just go short-term. There's nothing more to do on the early 2021. Too much of an unpredictable, chaotic year to go on any more a complex plan than that and longer-term perspectives. Okay, so we'll readjust as time passes on. Be smart. Lower the leverage on 2021 because lots of subjective context is going to be there. Using correlations, things you don't necessarily know about. Using psychology, things you might be going into a lot of subjective territory out there, which requires experience. So be smart, understanding that 2021, even if it's not necessarily as complex as I think it's going to be, you must at least prepare for reducing position sizing. And in that perspective, your returns are going to be lower. So prepare yourself for lower incomes into 2021, because if you go more aggressive, you're just probably going to take risks you don't nearly manage. And as this is what I'm trying to teach you guys, to efficiently manage the risk through time so you don't make the staggeringly biggest competition returns over the stupid retail traders on Twitter saying they made 10,000% for this year. Jesus, these guys are going to die 2 years from now at best. I'm just trying to make you traders, real traders, guys who survive for longer periods of time, and specifically endless. It means you're just never going to die as a trader because you're well prepared not to die. It's pure and simple it is. Okay, so be smart once again. As trading, aside from trading perspective, 2021 is going to be an important year for pro indicators, specifically because that's the project I'm working on for quite some time right now. And I think I can't say for sure for 100% because that would be just a pure lie. But normally throughout 2021, I suspect we should be able to release the semi-traded, semi-automated algorithm I'm so goddamn working on and hoping to get ASAP, because it's going to be a hell of a game changer for me first, and then for you, because of course I think it's going to be hell of a great help toward teaching you trading more efficiently, because helping you figuring out and processing your impatience biases with this algorithm is just going to be way easier than using alert system. Going to have to place trades on your things and stuff like that, knowing that most importantly, as timings will be pretty damn chaotic this year, programming your trades is definitely going to be absolutely necessary in 2021 and the years ahead. So this algorithm is not just the fancy stuff I'm looking for. It's just something that is going to be absolutely necessary for the years ahead, because I suspect market conditions will just go more and more complex, and we're going to need an algorithmic help to process this more efficiently. That's going to be all about it. Despite that, I'm still looking at the banking accounts to be open for the company so I can actually efficiently restore the subscription plans. So until then, just enjoy for indicators. It's been absolutely free for the entire 2020 year. Hope you enjoyed it. It's going to last probably, I don't know exactly how long. It's just that I do as fast as possible, because of course I need those subscriptions to get to recruit another coder to make this algorithm fasterly the development faster so I can actually release it earlier. Otherwise, if I can't restore the subscription plans, I cannot hire someone, which means I can hardly probably handle the 2021 release. So that's the only thing about it. I'm just not trying to make myself richer because of your asses. Just more importantly, you are actively participating into hiring someone who's just going to make the process faster. Probably even hiring 2 people to make it even faster so we can all profit from this. And let me be really honest, okay? I'm really doing this for me first. You're going to profit from it as well, but I definitely want this algorithm for me first. Okay, so that's the project for 2021. That's the only thing actually I'm working on very efficiently. Still background updating the indicators, but this is a process that is a never-ending system, of course. I'm always increasing, I'm always updating, always going for the little details and stuff like that. But most of this process has been done throughout the latest few years. So I suspect just a few updates through 2021. The only big topic is releasing this goddamn algorithm. That being said, I wish you guys a pleasant year. I hope this was pleasant for you if you traded with me in 2021. Like I said, 2021 is probably going to be less interesting in terms of financial reward, but I think as it's going to be more complex, you're probably going to progress a lot more into your trading. So take the bright side of it. Probably expect tinier returns, but probably more morally, psychologically getting ahead of your more professional trading in the future. That's the positive side of it. At least that's the best I think you can take out of 2021. That being said, see you guys later. That wasn't a good one.